opportunity. My name is Nailani Safaria and my study number is 022.
Thanks for the opportunity. My name is Inga Aminah Susmita Dewi. My study number is 2011310116.
Thank you for opportunity. My name is Nilia Febrianti Rofin and my student number is 2019 314 239.
What is the inventory? Inventory are assets held by the company for sale in normal business operation, or goods that will be used or consumed in making goods for sale. And then I will explain about kinds of inventory. The first inventory in trading company. Inventory are goods purchased by the company with the aim of being resold without changing the shape and quality of the goods. Or it can be said that there is no production process from the time the goods are purchased to be resold by the company. And the second, in inventory in industrial company. Inventory for industrial company are goods or material purchased by company with the aim of further processing into finished or semi-finished goods or may become raw material for other company. This depends on the type and process of the company main business. Inventory for manufacturing company generally have three types of inventory, namely raw material or direct material, work in process finished goods, and service company do not have inventory.
Okay, now I want to explain about types of supplies. Firstly is raw material. Inventory owned by the company which will be processed again throughout the production process so that it will become semi-finished goods or finished goods in accordance with company activities. The amount of raw material inventory is influenced by production estimate, the seasonal nature of production, the reliability of suppliers, and the efficiency level of purchasing, scheduling, and production activities. Goods in process are goods that still need a production process to become finished goods, so that the inventory of goods in process are strongly influenced by the length of production, namely the time taken from the time the raw materials enter the production process to the time of completion of the finished goods. And then inventory of finished goods. Finished goods inventory is inventory of goods that have been completed or products by the company and are ready to be marketed by the marketing department. I will explain about the purpose of the inventory assessment. The first is its attempt to match costs against associated revenue so that income is generated. This process is the basic objective of traditional accounting and based on the calculation of net income based on revenue at the time of sales requires an allocation of cost to the period where revenue is reported, namely cost of goods sold. Meanwhile, the unsold inventory value will be carried over to the next period in the company financial statements. The second objective of other inventory measurement is to present the value of the company's goods in the balance sheet component or financial statement. The third objective of measuring inventory is to help investor predict future cash flows, which is viewed from the amount of inventory as a resource that will support cash flow and the amount of inventory that will be sold at a later date and will affect cash flows.
Determination of inventory quantity. To determine the amount of goods that are still in control of the company at any time, it can be determined in several ways, namely 1. Stock option, calculation of goods at the beginning and of the calculate period. This method is a provision that must be done by management to determine the amount of ending inventory as one of the requirements for obtaining an uncaliphate opinion. 2. Use a perpetual recording method. 3. Using a combined method of perpetual recording and stock taking. 4. Using an assessment method based on an aggregative relationship, namely the gross profit method and the release inventory method. Basic inventory valuation, output value. In a state of determine the crucial event which is determined when the inventory is turned over to the subscriber or determine the selling value. It is more appropriate to use the output value method because it takes into account the value of the current inventory if it's sold at the time. The concept of output value has three concepts that we use, namely discount money received concept. This concept emphasizes the inventory can be valued by discounting future cash flow, provided 1. The value or price level is stable and there is high certainty. 2. The timing of cash received is explicit to provide sufficient certainty. Current selling price. This concept emphasizes the value of inventory based on the selling price or market, so that a fixed price is needed. So this concept requires 1. There is a controlled market with stable fixed price. 2. There is no large or material additional cost component, for example, interest or discount costs in the sales process. Net realizable value. In this concept, the calculation of costs arising from sales such as sales discount must be calculated in the net sales value or net realizable value. 2. Input value. Measurement of inventory with input value is a measurement of resources used to obtain inventory at current condition, so that for the supplies that do not need a prediction process, the interpretation of the value of inventory or input value is very clear, because the input value has described the flow of cash that has actually been used. The concept of input value is basically expressed by historical cost, or it can also be the current cost or standard cost. Current costs here use the concept of net realizable value minus the normal gross margin from net realizable value.
Okay, next concept of inventories. The first, historical cost. In the historical cost method, inventory is measured based on payment made in the past or must be made in the future to obtain goods or service. Therefore, if the payment is made in the future, the inventory price must be discounted to get the present cost. The second, current replacement cost. This concept is to reduce the weakness of the historical cost concept. Many authors and the accounting principle recommended using the CRC concept to measure inventory with consideration, as CRC allows the identification of holding gains and losses, as CRC is the current value of inventories. And in the third, net realizable values less normal markup. In the concept, inventory is valued using the concept of realizable values minus normal gross profit margin, so that the inventory value is the cost according to the realizable concept. Okay, next.
the reusable concept. Okay, next, combill. The assessment using the concept of combill is actually inconsistent and is not an inventory assessment based on a logical basis according to accounting theory, but rather emphasizes the element of conservatism. Uh, Next, standard cost. Current standard reflection production cost under current price and technology condition, and the value is the determinant after calculating the desired efficiency standard so that it resembles replacement cost. Fees to be included in inventory. The first, product cost, is the cost that is attached to inventory and is recorded in the inventory account. In the second, period cost, selling expense, and under ordinary circumstances, general and administrative expense are not considered to be directly related to the customer's acquisition or product and accordingly are not considered part of the inventory. And in the last, manufacturing costs. Manufacturing overhead costs include indirect material, indirect labor, and items such as depreciation, tax, insurance, heating, and electricity needed in the manufacturing process.
And next, I want to explain about cost flow assumption. The main objective of sorting out the cost flow assumption is to select the assumption that best reflect the periodic profit under prevailing condition. And one, special identification, used by identify every item that is sold and in the inventory post. The cost of goods sold include in the cost of goods sold, while the cost of special good that is still on hand is included in inventory. This method can only be used in circumstances that allow the company to separate out the difference physical purchase has made, and to average cost. The average cost method calculate the price of item in inventory on the basis of the average cost of the same items available during a period.
As well. There is difference in the perpetual calculation method. The cost of continue the explain from my time of sale. The first method is the LIFO method. In this method, the last purchase inventory recovery system has two methods, and the first is periodic system or cycle, which means that every final period of the cycle calculation is carried out to determine the amount of ending inventory. Companies that apply the periodic system generally have inventory the value is relatively small. The second method is permanent system or perpetual, which is the book inventory continuously, namely by recording every inventory transaction, but purchase and sales. Next.